Yeah. Good evening, everyone. A very warm welcome to each of you, and thank you for joining us today as we explore a vital area of transparent and effective business operations, financial reporting framework for companies and other entities. As we gather here, it's evident that financial reporting has evolved beyond mere compliances. It has become a strategic function essential for building trust, guiding decision making, and supporting sustainable growth. So, on behalf of the Corporate Laws and Corporate Governance Committee and our committee chairman, CA Dr. Debashish Mitra Sir, past president of ICI, it is my pleasure to welcome our esteemed speaker for the day, Mr. Himanshu V. Krishnadwala. Our speaker is a distinguished chartered accountant in practice since 1985 and brings an extraordinary depth of expertise in audit and assurance. His extensive experience includes leading India's implementations, conducting investigations and due diligence, and managing the conversion of financial statements from Indian GAAP to IFRS and US GAAP. As a director and audit committee member for various companies, our eminent speaker provides invaluable insight into financial reporting and governance, backed by his comprehensive background in practice, academia, publication, and professional services. His dedication to excellence in accounting and finance has made him a true leader in the field. Thank you, sir, once again for being here, and I look forward to the valuable insight that will really emerge from today's discussion. Now, I would request, sir, to please take forward the session. Welcome, sir.
Yeah, thank you, Nisha and Seema for asking me to take this session. Is my voice audible, clear enough?
Yes, sir. Yes, sir.
So I think this is a topic which looks very basic, but I think if you delve deeper into this topic, there are so many nuances on how the reporting happens, what is the financial framework and all, which we are going to see in the next maybe 90 to 100 minutes, followed by question and answer. And in fact, question answer we will have at after the end of each particular topic within the presentation as such. So feel free to post your queries or everything on that chat box or on the Q&A or whatever. So I will just start and share the presentation. Right, is this visible to all?
Yes, sir.
Right, so the topic for discussion today is financial reporting frameworks for companies and other entities. Now, the very name of this topic clearly means that it is not something very great because you will say, okay, when I report something for companies, I will follow the Companies Act. When I report for other entities, there is nothing available as such. So what is there to talk about in this topic per se? However, if you look into the various nuances which are there, there are several things which need to be looked into when you are reporting for companies or reporting for other entities which are there as such. And all of this becomes relevant for all of us professionals because if we are not following the disclosure and the standards and whatever reporting requirements are there under the respective financial reporting framework, the regulators like SEBI, like the Ministry of Corporate Affairs, NFRA can obviously say that you are not correct in your work and they can obviously penalize you or debar you and take some action against you. And that is why these are some basic things which are important. And to just give you a simple comparison, when you try and learn driving a car, you are told that yes, this is the clutch, this is the road in which it functions, this is the left hand side, right hand side driving, and so on. Now that's the basic framework of driving a car which you learn initially when you start learning driving a car. Similarly, when you are trying to report on something, when you are trying to make financial statements, a reporting framework is something of that nature, without which you just cannot proceed in that sense. And that is why a reporting framework carries very importance, a lot of importance to understand before you even do any basic accounting or you try and to get into auditing something as such. So let's start with some initial things. Now, the applicability of a financial framework to various entities in India. Now, broadly, we are dividing into two things. One is companies under the Companies Act 2013, and the other part is other entities which are there. In the Companies Act 2013, you have different type of companies. You have small companies, one-person companies, dormant companies, private limited companies, public companies, listed companies, and companies incorporate under Section 8 of the Companies Act, which we understand are companies formed for non-profit purpose or companies formed for charitable objects. So within the Companies Act, you have got these 7 types of companies, and we will see how the framework applies to them. When you come to other entities, you have got LLPs and you have got LLP Act, which is there. You will have a partnership firm, which can be either registered or unregistered. You have charitable trusts or private trusts or any other type of trusts. You have got proprietorships. You have got AOPs. Now, all entities in India are broadly divided into these two categories. One would be a company, which would be one of those 7, or you will have any other entity, which would be one of these 5 which are there as such. Now, what applies to the framework when you prepare your financial reports? So when it comes to companies, to all those 7 companies, you have a framework which is given as per Section 133 of the Companies Act 2013, which is nothing but your Schedule 3. And Schedule 3, as you know, has 3 divisions, Division 1, Division 2, and Division 3. And for your other entities, your LLPs and other similar entities, for your financial statements, the framework is as per the guidance note on financial statements for non-corporate entities and LLPs, which has been issued by ICAI in the last year. A formal guidance note was issued only in the last year, somewhere in 2023 by ICAI, which forms a framework for preparation of financial statements for non-corporate entities per se. So this is the background as to what we are going to discuss in the next maybe 90 minutes or so. How is the framework applicable to companies and how is the framework applicable to other than companies, and what are the different nuances in each of these frameworks, and getting into more details on each of these frameworks per se. Now, when you have a financial reporting framework, which we are going to call it as FRF, the components of an FRF are broadly your balance sheet, statement of profit and loss, cash flow statement, your notes to financial statement, statement of accounting policies. Sometimes we write significant accounting policies, sometimes we write material accounting policies, depending on whether you are following Ind AS or not following Ind AS. And you also have something called statement of changes in equity, which is applicable only for those who prepare Ind AS financial statements. So whenever you have a financial reporting framework, now whether it is for a company or a non-corporate entity, you will typically need these 5 things. The 6th thing is an optional thing, which is applicable only for Ind AS, but these 5 things, balance sheet, statement of profit and loss, cash flow, notes to financial statements, and accounting policies, is there in all financial reporting frameworks, whether it is for corporates or non-corporates. If you are a corporate and also following Ind AS, you will also have statement of changes in equity, which needs to be prepared and presented. Now, let us first look at the FRF under Companies Act 2013, which we are all frankly much more familiar with than any other entities which are there as such. So you have got Section 133 of the Companies Act, which tells you how to make financial statements, and that's the basic framework. And the Schedule 3 gives you 3 divisions. Division 1 is for non-Ind AS companies. Division 2 is for Ind AS companies, and Division 3 is for NBFC companies or companies engaged in non-banking financial activities which are there as such. If you are a bank, if you are an insurance company or anyone covered by RBI or IRDA, they have their own separate framework. So we are not talking about that framework, because if they are a bank and a company, they will also have to follow multiple frameworks, the framework of the Companies Act as well as the framework for additional information given by RBI also in that sense. And we will see that little bit down the line per se. Now, how does these 3 divisions get distinguished as such? So if you are looking at division one, which is, if you look at division one, it is non-Ind AS companies. So all companies below that net worth of 250 crores or companies which are not listed. Now in that framework, in the balance sheet, the liabilities are presented first and the assets and liabilities are classified as current and non-current only. So here, remember, you have liabilities first and then the assets, which is in the division 1 of schedule 3 as per section 133, which is there. When you come to division 2, which are Ind AS companies, assets are presented first and liabilities are presented later on. But here, assets and liabilities are bifurcated as financial and non-financial along with current and non-current. You can see that once you go to Ind AS, your classification become much more finer, because if you go one slide back, here it is only current and non-current. Here, in addition to current and non-current, you are also bifurcating assets and liabilities into financial and non-financial, which means you are getting into more granular information when it comes to division 2, which we understand as Ind AS financial statements, which are there as such. When you come to division 3, assets are presented first and assets and liabilities are bifurcated as financial and non-financial, and financial assets and liabilities are presented first. Now, since this is a non-banking financial company, everything what is financial comes first. So though financial, non-financial is similar to what we have in Ind AS division 2, here the only difference is everything financial, either assets or liabilities, are presented first and then all the non-financial assets or liabilities. And the reason is simply because here we are talking about a company which is dealing only in money, and therefore everything which is financial comes first. Obviously, assets also come first in this case as such. When you come to the statement of profit and loss account and division 1, now division 1 is non-Ind AS financial statements. In this case, there is nothing like other comprehensive income, since there is no OCI applicability to non-Ind AS companies which are there. But if you come to division 2, there is something called as OCI. So other comprehensive income which is there. And if you see the slides, on the left-hand side of each of the last 5 slides, we have actually taken a picture of an exact P&L as it appears in a company and just put it there for easy reference as such. And all this, the entire presentation, in fact, after the session today, I will send it to the institute and they may host it somewhere where you can easily access that particular thing. So you don't need to really take pictures of the slides or write down anything. You will get the entire presentation as it is, maybe by tomorrow or something. Now, what is this other comprehensive income which comes in division 2, which is for Ind AS financial statements? Now, typically all currency translation changes, then gains or losses on net investment hedges, gains or losses on derivatives qualifying as cash flow hedges, unrealized holding gains for sale of debt securities, gains losses for pension or post-retirement benefits, and fair value of financial instruments measured at fair value through OCI. Now, these are 5 typical things which normally run through a other comprehensive income statement in a Ind AS profit and loss or in Ind AS financial statements which are there. Now, a question which someone may have is, if I have got, say, gains or losses for post-retirement benefits and I'm not following Ind AS, but I am doing as per division 1, where do I take those gains or losses? And the answer to that is I take it directly to the main profit and loss accounting, because for division 1 companies, I don't have any section like other comprehensive income. So in that case, I will take it straight through my profit and loss account or statement of profit and loss. But in Ind AS companies, those things will get routed through other comprehensive income as such. If you come to division 3, division 3 is for non-banking financial companies, financial statements. Now here, as part of the income, it is mandated that interest income, fees and commission income are to be shown separately, because that is the crux of the income. It just cannot be clubbed together as revenue from operations. If you look at division 2 and division 3, if I just go backwards, it will just say revenue from operations and the details go in the notes to accounts. But in division 3, It will come right on the face of the P&L, interest income, fees and commission income, which are shown separately because that is nothing but revenue from operations for a non-banking financial company. So they need to be disclosed right in the beginning in the profit and loss. And here also, there is a disclosure for other comprehensive income which is there. Now, what happens if a NBFC is having a net worth of less than 250 crores, but it is a NBFC registered with RBI? Now, in that case, a question which always comes is whether do I follow division 1 or division 3? I don't need division 2 because I am a non-NBFC company. So it is either division 1 or division 3. Now, if I fall under division 3 because I am a NBFC and that's a specific classification, then I will follow division 3 and also show the OCI. Though as such, I am not falling under Ind AS because my net worth is less than 250 crores or I am not listed. So for a NBFC, if I have to choose between division 1 and division 3, I will have to go with division 3 because as a NBFC, there are specific disclosures, specific formats given. So I will have to follow division 3 only and nothing else which is there as such. And if you really prepare in division 1 and you are an NBFC, then you are actually going into a wrong framework because then you are giving information which is not as per the applicable framework for that NBFC as such. Now, besides this balance sheet statement of profit and loss, you have a cash flow statement. Now, this applies in all cases. There is some difference in the classification of what is operating income, what is investing activity, and what is a financing activity, depending on whether you are an NBFC or not. But a cash flow statement is applicable in all cases, whether you are division 1, division 2, or a division 3 company as such. The details of operating activity or investing or financing, details of what comes in what, then goes with the applicable accounting standard rather than Schedule 3 divisions which are there as such. So as far as the Schedule 3 is concerned, cash flow statement is a common statement for all three types of companies, non-Ind AS, Ind AS, or NBFCs per se. Then you have something called a small company in the Companies Act. Now, small company is a company which is not listed or not in the process of listing, which is not a bank or an institution or an insurance company. Turnover does not exceed 250 crores. Borrowings not exceeding 50 crores at any point on time, and which is not a holding or a subsidiary of another small and medium-sized company. Now, that's the definition of a small company in the Companies Act. Similarly, you have a definition of a one-person company, which means a company which has only one person as a member. And this is a special type of company which is used by a lot of entities for parking their intangible assets. Say, for instance, I possess a very valuable intangible asset. I will, instead of holding it in my personal name, open a one-person company and then park that intangible patent or copyright something in that particular company so that it is easier to sell to someone else. Now, if you are a small company or a one-person company and they are called SCs and OPCs, now SCs does not mean here scheduled caste. It really means small company. In an election environment, SC always is read as scheduled caste, but it's not scheduled caste. Small company is what is there in the Companies Act. So for SCs and OPCs, there is an exemption from preparing of a cash flow statement. They don't need to report on internal controls on financial reporting. There is no mandatory rotation of auditors. The merger and amalgamation provisions are simpler. And there are several other compliances like meetings of directors, filing of annual returns, penalties, and so on. And there would be a lot of companies which are actually private limited companies, but they may still be classified as small companies because if you see the turnover and the borrowing criteria is fairly high at 250 crores and 50 crores. So there is a possibility, and we have come across this in our practical experience, that the company actually is a small company because it say just has a turnover of 100 crores, no borrowings, family run company, and the owners or the directors are not aware it is a small company and it can enjoy several benefits which are there as such. So look at the definition of small company. It's a very wide or a broad definition, and If you fall in the definition, do take benefit of these exemptions which are allowed. Okay. Now, besides this, there is something called as SMC, which is small and medium sized company. Now, this comes from not the Companies Act, but this comes from the accounting standards which are notified under Section 133. Now, accounting standards notified under Section 133 are two sets of standards. One set of standard is non-Ind AS standards, and the other set of standards is Ind AS standards. If you look at the non-Ind AS standards, there is a definition of SMC within the standard. And that is a very similar definition, which is there for even a small company, which is there as such. Now, in case you become a small company, there are relaxations which are applicable to small companies or SMCs as they are called in the accounting standards. And besides what is given in the Companies Act, from an accounting perspective, from the standards, and this comes from the rules which are there as per Section 133, the accounting standards which are notified and the rules. So you have these 5 standards which are not applicable: cash flow statement, segment, discontinued operation, related party disclosures, impairment of assets. And there are relaxations given in several other standards which are there as such. Okay. So keep track of this also, because if you are SMC as per the rule, as per accounting standards applicability, as well as a small company, then you can enjoy several exemptions which are there as such. And as we saw earlier, even on the reporting aspect, you will have exemptions on not having to report on internal controls on financial reporting, which is there as such. Okay. Then, if you are a company, there is obviously consolidation which applies. This does not apply to non-corporate entities, but it applies to corporate entities. So, a company having one or more subsidiaries shall, in addition to financial statements, also prepare consolidated statements and all its subsidiaries in the same form and manner which is presented before the AGM. Now, if the holding company is following Ind AS, the LLP subsidiary company is also required to follow Ind AS. So, this is something you'll need to remember. If a company per se is not falling under Ind AS, but if the holding company is following Ind AS, then everything else will need to follow Ind AS. Now, that includes not only companies, but it can also include a LLP subsidiary. Because if you have a LLP subsidiary, that LLP, though it is not otherwise mandated under Companies Act to do anything, because it's a subsidiary of a corporate entity, the LLP subsidiary will also have to follow Ind AS to prepare its financial statements, which are there for the purpose of consolidation. And here sometimes you have got multiple work to be done, because the LLP, for filing its return of income under tax or under ROC for its standalone, will prepare as if it is not following Ind AS. But for the purpose of preparing consolidated financial statements, it will again have to reconvert the financial statements for consolidation under Ind AS per se. Okay. Now, this is really a FRA for companies. I'm going to stop here for some time. I, in fact, will stop sharing so that in case you have had any queries so far, we can take queries or any comments so far what we have seen as such.
So,
So,
sir, we
anything?
can continue, sir, since we have received no queries as of now. But yes, our registration has reached to, sir,
Oh,
thousands are the viewership, sir.
okay, good. I don't know whether it is good or bad or this is a normal thing. Anyway, we will continue then. I will again start sharing this. And we'll go to that FRF for other companies. So this is financial reporting framework for other entities which are there. Now, if I look at a balance sheet of a non-corporate entity, and we saw earlier this format comes from the guidance note of the institute, which came in 2023. And this is, though of course a guidance note is not mandatory for the entity, it is more or less mandatory for the auditors or people who are even giving tax audit reports for non-corporate entities. So though this is recommended from the entity's point of view, it is much better if everything is prepared in this, because the income tax department or even a Reserve Bank of India will look at this format in a better way and assume that the company is a much better company for the purpose of presentation and other things. So the balance sheet for a non-corporate entity now, whether it's a LLP, whether it's a partnership, whether it's a proprietorship or a trust, you will have to follow this particular format. And then here you have got liabilities which come first, starting with share capital, reserves, non-current liabilities and current liabilities. And then you go on to the assets of the balance sheet, non-current assets and current assets which are there as such. And if you see the different columns, you have got note number, because you will explain in the notes for the details of that particular line item. And everything has to be given for the current year as well as the previous year. And we will talk about this little more later on also. Now, if you have got owners or partners funds, you will have to give opening balance, capital introduced or contributed, remuneration, interest, withdrawals, share of profit or loss for the year, and closing balance. Now, this for a company, all this just goes as share capital. In a company, there is nothing like remuneration for shareholders, but in a non-corporate entity, you will have all these things, because whether it's a LLP or a partnership or a proprietorship, you will have all these things which are given to either the partners or the proprietors or anyone as such. Your profit and loss account for NCE. NCE is a non-corporate entity. You start with revenue from operations. Now, if your non-corporate entity is even doing non-financial NBFC activities, you will still follow this format only, because there is no other format recommended by regulation for a non-corporate entity. And this is, as I repeat, given by the institute in the form of a guidance note. So revenue from operations, other income, and then you write all your expenses one by one, which we are normally used to. And then you have got profit before exceptional and extraordinary items, partners remuneration and tax, exceptional, extraordinary remuneration tax. And finally, you have got profit from continued and discontinued operations. Now, if you see here, the institute, when it has given this format, has tried to put in some things which are otherwise applicable only for companies, like say your tax expense to be shown separately, the concept of extraordinary and exceptional, the concept of continued and discontinued operations. It is nowhere really in that sense relevant for a partnership or an LLP, but this terminology has been brought in from the company's financial reporting framework, so that there is a proper comparability and commonality which is approached by all sorts of entities which are there as such. Now, so as we said, for a non-corporate entity, the only format is as per the guidance note of the institute which is there. If you look at the types of non-corporate entities, we said there are LLPs, there are partnership firms, there are proprietorships, there are AOPs, and there are trusts. Now, if you are a trust and if you are governed by something like, say, the Bombay Public Trust Act, which applies in the states of Maharashtra and Gujarat, that particular act has given a format for preparing financial statements. So if you are in that state, you may need to prepare, in addition to this format, also something in that particular format. But that is localized. It is not something which is applicable across the country. It is localized. The Bombay Public Trust Act is localized only to the states of Maharashtra and Gujarat, which is there. So for a non-corporate entity, you will have to be little more cautious as to, besides what is given by the institute, is there any regulatory disclosure which is necessary as such. Then some important aspects of a FRF, and this will apply sometimes to both corporate or non-corporate, and it will be given in the respective slides as to what is applicable to companies and what is not applicable to companies. Now, these are only some important aspects. These are not entirely all aspects of an FRF, because for that you need to understand or go through the entire Schedule 3 in detail, which I'm sure all of you prepare financial statement, read financial statements, you know what is Schedule 3, whether Division 1, 2 or 3. But some of those important aspects of FRF are something which we are just summarizing here. The first of such nomenclature is this classification of current and non-current. Now, This comes from the Schedule 3 background itself. So any asset is to be classified as current when it satisfies the following criteria. So expected to be realized within the operating cycle, held primarily for being traded, expected to be realized within 12 months, and it is cash or cash equivalent. And again, it is to be used for a liability for at least 12 months after the reporting date. So typically the current non-current criteria falls within this 12-month period which is there. Anything else is classified as non-current. However, there are some sectors, there are some industries where this 12-month period can be altered. Say, for instance, you are a real estate company and you construct flats and sell the flats. In a real estate company, if you are taking, say, a minimum period of 24 months to construct a flat and then to sell the flat, the company may as well decide that for the purpose of current and non-current classification, I will take a 24-month period or I will take a 15-month period rather than this period of 12 months, which is there. Because 12 months is a normal thing, but you can, with reasons, change that period to any other period as may be applicable to your particular industry as such. You can even have a smaller this operating cycle thing as such. Say, for instance, you are making something seasonal like, say, umbrellas. Your umbrella manufacturing, nothing else done. Your operating cycle may be only 3 months because you do everything maybe in just those 3-month period within a particular year as such. Of course, if you are in umbrellas expecting that it would rain only from July to September now, I think with this climate change happening, even for such companies, your operating cycle will need to be extended now because now it starts raining anytime during the year for any region as such. When it comes to liabilities, again, the same criteria expected to be settled in the normal operating cycle, held primarily for being traded, due to be settled within 12 months, and it does not have an unconditional right to defer settlement. Now, everything else is classified as non-current. Now, you may feel that why is this classification important, current and non-current? This classification is extremely important, especially from a bank's point of view. When you are taking a loan from a bank or when you are filing your working capital statements with a bank, this current and non-current is very important because a lot of your ratios depend on the classification of current and non-current. And therefore, sometimes we have seen that in practice, if you have got a vendor, if you have got a customer, and the customer is given, say, a credit term of, say, 24 months, then whether that customer's receivable is current or non-current is need to decide because, and I'll give you a practical example. Say you are in the contracting sector and you tell the customer that since I am in the contracting sector, I am going to give you, say, 18 months credit. Now, if you are giving a 18 months credit, then it is exceeding this 12 months and whatever is for that 18-month period will actually become non-current, though it is nothing but a trade receivable as such. Okay. So such things you will have to keep in mind, and therefore this classification of current and non-current becomes very important. If you have got, say, retention money can be either as a vendor or as a customer. If your retention money is, say, 24 months, 36 months, 60 months, sometimes that retention money which is exceeding 12 months will be a non-current liability or a non-current asset, irrespective of the fact that otherwise all your that particular customer or vendor is within the current classification as per the normal operating cycle. Now, how do you determine the operating cycle? Now, operating cycle, now this is a terminology which you learn during your student days in your maybe your costing lectures, which are costing subject which is there. But again, very important from understanding of financial reporting framework, because this decides what is current and non-current as such. So acquiring raw materials to finished goods to making the sale to realizing cash and again taking raw material. Now, the time it takes to complete this cycle is called operating cycle. As we said earlier, it is assumed that the operating cycle is 12 months, but you can change that cycle to something more than 12 months or lower than 12 months also. So if you have a operating cycle of 120 days, which I said could be for the seasonal industry, then all your classification of current and non-current will go as per the operating cycle which is applicable to your particular company or the sector as such. And when Schedule 3 came in, maybe somewhere before 10, 12 years, uh, there was a big debate as to why should we only have 12 months? Why not let companies decide their own operating cycle? And finally, after a lot of debate, the guidance note which came from the CLCG committee said that let it be 12 months. It would be a rebuttable presumption. If a company can prove that it has a cycle which is more or less, then let them give the reasons why they want it more or less. But otherwise, for common comparison of financial statements, let the operating cycle be 12 months. If you want it 12 months, you don't have to prove anything. It is assumed to be 12 months. If you want anything other than this, you please prove that your operating cycle is lower or higher than the 12-month period which is there. Then rounding off. Now, this is something which lot of people, lot of companies, lot of auditors still miss out. Now, for corporate entities, Schedule 3 itself gives you what is the rounding off required. You will also be surprised to see that the guidance note of the institute has also mandated a rounding off for non-corporate entities. And the words used are shall and may. Now, even if it is may, it is interpreted that it should be shall only because the ROC does take a lot of objection if you are not really going to round off in that sense. However, the institute in the guidance note, for maybe because the institute does not have the mandate, the Companies Act Schedule 3 says shall. The guidance note of the institute says may. However, if you are doing a consolidation, it is always better to have a rounding off so that it is easier to consolidate in that sense. Okay. And this is how the rounding off has to be done. It is not that you can decide how you want to round off. You'll have to do it in this particular manner only. Comparative information. Now, for companies, we are used to give comparative information. But for non-corporate entities, the guidance note again mandates that you need to give comparative information, except obviously for the first year's financial statements which are prepared and which are given as such. So for first financial statement, no comparison, but for all other financial statements, please give comparative information now, whether you are a corporate entity or a non-corporate entity per se. How do you charge depreciation and provide amortization? If you are a corporate entity, over the useful life, which is given as per Schedule 2, you can follow a different useful life if you are able to justify with some internal or external evaluation. So typically, all corporate entities take a useful life which is given per Schedule 2. However, there are a lot of companies, especially listed companies, who say that I want to depreciate at a faster rate. For instance, items like computers, items like, say, mobile phones, they will say that though the Schedule 2 allows me a 5-year life for computers and all, I would like to follow a 3-year life. A motor car, which otherwise is given 8-year life, lot of people say that let me follow a 5-year life. Now that is possible, but you need a justification which needs to be in writing, which needs to be put down on record. So even if you are an auditor and a company is following a useful life other than Schedule 2, as an auditor, you need to take on record as to how the company has justified this. And this justification may be needed year after year. It's not just in the first year, because in the first year, you do not know what was the justification. That justification can change year after year. So every year you will need that justification with some internal or external evaluation. Now, internal evaluation could be a internal engineer certificate or your production head certificate or a managing director certificate. External clearly is a vendor or someone external expert whose evaluation you take. For a non-corporate entity, depreciation is just as per the life of the asset, nothing given by any regulation. You just follow that accounting standard 10, which is there, which says as per life of the asset. However, what we have seen is, in practice, everyone takes the rate which are prescribed by the Income Tax Act. Now, Income Tax Act does prescribe accelerated rates of depreciation. They are not typically following the life of the asset. But we have seen whether a partnership or a LLP, they will take the rates which are given by the Income Tax Act. And the reason is very simple. They don't need to do that duplication. when they are calculating depreciation for the income tax allowability. So for convenience, they take that, which is okay, which is allowed, but you will have to disclose that fact very clearly that depreciation is considered, rates are considered as per the Income Tax Act, the rules which are there. When you come to corporate entities, since you are following a useful life as per Schedule 2, which may not necessarily be as per the rules of the income tax, for calculating depreciation for a purpose of calculating the taxable income, I'll have to add back the depreciation as per Schedule 2 and rework the depreciation as per the Income Tax Act. And that is typically what also gives rise to that deferred tax liability, because in income tax, it's accelerated depreciation in most cases. In the Schedule 2, it is a lower rate. So typically, you will come across a deferred tax liability in corporate entities which follow useful life as per Schedule 2. In non-corporate entities, you may normally not find the deferred tax liability on depreciation because, as I said, in most cases, they would follow the rates which are given by the Income Tax Act itself. Then you have got several disclosures as per the MSME Act, which is there. Now, this applies to both corporate and non-corporate entities. So, if you are having any dealings with a MSME, we have to disclose the principal amount, interest due, the interest actually paid to the buyer in terms of the section 16, what is the interest due and payable, what is the interest accrued and remaining unpaid, and further interest remaining due and payable. This again is a big pain point for all companies or enterprises because the act mandates that you have to pay interest at the rate of 18% or something. However, in most cases, companies say that though I have delayed the payment beyond the statutory period, I am not going to pay the interest, nor am I going to provide the interest. And the statutory period, as you know, is now 45 days. Within 45 days, I have to pay all my MSMEs, and otherwise, these disclosures will come in as such. Now, most companies will have to give this information. They may not provide for the interest. They may, however, say that the payment to MSMEs are made as per contractual terms, and even in case of delays, interest has not been demanded by the MSME vendors, and hence no provision for the same is made. They will also further disclose that the identification of MSME is as per information which we have got from the companies per se. Now, as auditors of entities, you will have to validate this disclosure, and it is important as to how do you validate the disclosure, because if a company is not providing the interest, a disclosure is required that the interest is not normally paid to a vendor even if the amount is delayed beyond 45 days. You can also say that even and the amount, if at all they will pay, is not likely to be material, and therefore no provision is necessary. All of you would also remember that from this year, you have got an amendment in section 43B, where interest, which is payable to a MSME, or the principal also, which is now payable to a MSME, where payment is not made within 45 days, is likely to be disallowed under section 43B. So MSME, as I said, is a big irritant, frankly, in preparation of financial statements and when you are doing the audit of entities, because it is something which theoretically looks very good. The government says we are encouraging the MSMEs or something, but practically, if you ask any of your clients, they say that we are not likely to pay them any interest, and we will change the contractual terms. And we will sometimes, some companies come and say that, okay, we will make a check within 45 days, but we will give it to them after, say, 90 days, and it appears in the bank reconciliation. So theoretically, this is something very good which the government has done, but practically, I think we have a big challenge in giving this disclosure and even validating the disclosure as auditors for the purpose of our attestation of the correct disclosure for the MSME Act, which is there. When it comes to corporate entities, you have got this disclosure of trade payables aging schedule, and this is only for corporate entities. So again, here you have to give what is MSME outstanding for not due 1 year, 2 years, 3 years, more than 3 years, and so on. disputed dues, non-disputed dues, and we have just put some ad hoc figures in this table rather than giving just a listing. We thought this table will give a better picture of how things are represented. Now, though the companies can get this information very straight from any of the accounting softwares which they are following, you should remember that this is also a very important analytical tool for our audit process. For instance, if you have got here trade payables, which are say 2 to 3 years and more than 3 years, a automatic question has to be given to the company saying that why you are not paying these vendors. And unless they come up with a valid reason, you will have to say that please write back this payments or write back these amounts, or you may have to adjust this against something, or whether is there any litigation pending on these amounts which are there. So you may normally miss this out, but because it is now part of Schedule 3 disclosure itself, it automatically becomes part of your audit process as to how you start questioning the companies about these old payables which are there as such. Similarly, you have got this trade receivables again for corporate entities, and you have got again undisputed, disputed, with which have a significant increase in credit risk, credit impaired, and so on and so forth. And this is for Ind AS. For Ind AS, only that credit impaired thing lines would be removed because there is no provision really which is required for ECL as per non-Ind AS. But again, this gives you a lot of analytical information. Again, for that 2 to 3 years and more than 3 years, why the money is not received? Is it a legal case? Are you still transacting with that customer? Now, all sorts of questions you will start asking the client because this information is now readily available and also presented in the financial statement. Information was always available, but it was never presented in the financial statements before this change in came in Schedule 3 before maybe about 2 3 years. And one should also remember, whether you are a preparer or an auditor, that this information is also now available to regulators. So whether it's the Income Tax Act or the GST Act or GST officials, they also get this information when they look at the financial statements, and they can come up with questions based on this to determine your taxable income or other things as such. For non-corporate entities, when it comes to trade receivables, you only write more than 6 months and whether secured, unsecured, or doubtful, and provision made for doubtful debts or not. Now, non-corporate obviously is much more simpler, but if you see from a proper perspective in a corporate, if you are giving more details, your audit process also would be better. In a non-corporate, because you are not giving more details, your audit process can also shorten because you may not be able to pay attention on those details which are there as such. When it comes to share capital, for corporate entities, you have to give a host of information. You have to give promoters, what are their shares held, what is the percentage of shares, what is the percentage change during the year, and so on. All this is not there in a non-corporate entity, but in a corporate, you give all of this. You also give something like a statement of changes in equity disclosure as to what are the changes in equity, and in case it is changed, there are changes due to some prior period errors, then the balances have to be restated at the beginning of the current reporting period. And this is obviously for Ind AS financial statements, where you also apply Ind AS 8 in such cases. Property, plant, equipment, specific rules given in Schedule 3. Now, whether Schedule or Division 1 or Division 2 or Division 3, the same rule applies. Show a separate line item if there is a revaluation greater than 10%. This is obviously not there in the non-corporate entities. In corporate entities, in income, total revenue is replaced by total income. You have revenue from operations, other income, and then total income. It doesn't say total revenue. Then the company is required to disclose undisclosed income. This is again, which is a new addition to Schedule 3, which came before a few years, that if there any undisclosed income which you have now disclosed because of a search which happened in the company's case, this is not there for non-corporate entities. Disclosure about CSR. This obviously all of you know is something which again is a big irritant, because a lot of companies do not want to pay this money, but they are forced to pay this because CSR is a mandatory section now, section 135. And In case there is a shortfall, you have to clearly disclose a lot of things. What is the previous shortfall, reason for shortfall, and so on. And if you have reported on this or audited this, you will also realize or recollect that there is a specific clause in CARO 2022 where you have to report on compliance with the CSR provisions for a company. Again, not really applicable to a non-corporate entity. Cryptocurrency disclosure, corporate entities, you have to disclose all this. And I'm sure those who are tracking cryptocurrencies would realize that after the winning of President Trump in the United States, the cryptocurrencies prices have almost increased by 30%. The quoted price of that cryptocurrency has increased by almost 30%, which is what I believe in the next 4 years when President Trump is going to be there in office, cryptocurrencies would gain much more visibility, especially in the United States and all other countries which deal in United States as such. I am sure in India also this will gain much more visibility. Though the government does not like cryptocurrencies, it has to gain visibility because United States, the fact that after Trump got elected, it went up by 20-30% itself shows that cryptocurrency will play a much bigger role in the next 3 or 4 years. And hence this disclosure becomes very important for a company as such. Some additional disclosures for a corporate entity, and this all came before last few years. Title deeds of immovable property, whether held or not held in the name of company. Are you doing a revaluation? Are any loans given to KMPs or directors or related parties? What is the aging for capital work in progress? Then details of Benami property. Are you a willful defaulter? Relationship with stuck-off companies. Enhanced disclosure for borrowing from banks and financial institutions on the basis of security. Then whether all your charges are registered. Compliance with the number of layers of companies. Ratios to be disclosed. Compliance with approved scheme of arrangement and utilization of borrowed funds and share premium. Now, if you look at corporate entities, the level of disclosure is far more complex as compared to non-corporate entities. And if you look at the statistics which are given by the registrar of companies, you will see that a lot of businessmen today prefer to form LLPs rather than private limited companies. Tax is only one reason. Tax is obviously beneficial because you can distribute money to the partners of a LLP without any additional tax. But another reason is much lesser compliances for a LLP. And that is why private limited companies are not really a very favored instrument to prepare now, except when maybe you are having a joint venture or someone is still enamored with a private limited company. When you come to non-corporate entities, this disclosure, which is there in a Schedule 3 of corporate company, is also there for non-corporate entity. And this comes again from the guidance note. Now, employee benefits, you break up like this. Any expenditure which is exceeding 1% or 1 lakh, which is higher. Adjustments to carrying amount of investments, net gain or loss on foreign currency transaction translation, exceptional and extraordinary prior period. Now, this is nowhere there in any statute, not there in LLP Act or the Partnership Act, but it is coming by way of a guidance note of our institute for non-corporate entities. Similarly, you have got this additional information to be given in non-corporate entities, again coming from the guidance note. This is similar to corporate entities, but it is important to note that if you are even doing a tax audit of an entity, which is what we normally do if your entity is a non-corporate entity, because there is no other audit mandated. All these disclosures will become necessary because these are mandated disclosures as per the guidance note of the institute. And as members of the institute, if we don't follow the guidance note, the auditor has to give very concrete reason as to why he is not following the guidance. And giving all this information and not giving the information, I am sure besides ignorance, there is no other logical reason for a non-corporate entity not giving this particular information as such. Now we saw that there is something called exceptional items in the formats which are there. Now exceptional items have not been defined anywhere, neither in the AS nor in the Ind AS. However, uh, when income or expenses are of a particular size or incidence or nature, it is better to disclose them separately since it is then relevant to explain the performance of the enterprise. And therefore, such items are called exceptional items. Now, what you typically have as exceptional is, and this is from the practice followed by several large companies, write down of inventories, restructuring, disposal of PPE, discontinued operations, impairment, litigation, settlements, and so on. Now, there is a notion that exceptional item is always a one-time item. Now, that is not correct. Item can be exceptional even if it is recurring. Say, for instance, you have got discontinuing operations which can recur year after year. It will still become an exceptional item. You can have impairment of assets which can be there once in few years. So it's not as if that because it is a one time, it automatically becomes exceptional. It has to be of such a nature that it is better to show that separately in that sense. Now, if you are a dealer of, say, shares and securities and you make a loss in a particular trading activity, you cannot show it as exceptional because that is part of your regular activity. If there is a fire and there is a loss due to fire, you cannot show that loss as an exceptional item, nor is it coming in this example. Because if you're running a factory, a loss by fire is a normal activity within your business activities. So exceptional items disclosure is to be considered exceptional, is to be taken as exceptional. It cannot be a normal thing as such. And therefore, in spite of the fact that there is no definition given of this, it should be of such significance that it is important to disclose that separately to explain the performance of the enterprise per se. As against this, we have got something called extraordinary. Now, extraordinary is not a concept which comes in Ind AS, nor does it come in Schedule 3 in that sense. So, for corporate entities, there is no possibility of showing anything at extraordinary. However, the same is possible in non-corporate entities because the guidance note of the institute talks about extraordinary items. Now, what are extraordinary items? Now, this could be one-time items. Now, the typical example which people give is, say, for instance, you had this terrorist attack which happened in Bombay, which happened in United States, and if you had a loss due to a terrorist attack, that is something you can consider an extraordinary item because you are not expected to have a terrorist attack every year and suffer a loss out of it. But again, corporate entities not possible because Schedule 3 does not support it, nor does any accounting standard support it. So in a corporate entity, if you use the word extraordinary, you are definitely going wrong somewhere. You can, however, consider in a corporate entity to show it as an exceptional item. It just cannot be extraordinary. Non-corporate entity possible because the institute's guidance note itself has used the word extraordinary, which is there in the format of profit and loss statement. Okay. Now look at this summary of disclosures, and I'm sure a lot of you may find that some of these things are getting missed out when you are doing the audits. Look at corporate entities. My basic disclosure comes from where it comes from Schedule 3, whether it's Division 1, Division 2, or Division 3. Then I have to also add to it some specific sections of the Companies Act. For instance, Section 186(4) mandates some extra disclosure to be given in financial statement. If you have given a loan, if you have an investment in other companies, it mandates extra disclosure. Then corporate entities have a lot of disclosure to be given as per the applicable accounting standards. So if you take, say, for instance, AS 109, or if you take AS 29, for a non-Ind AS, you will have a lot of disclosures which come as per the accounting standards. You have to give all that. Then we have seen disclosures which are required as per MSME Act. And if you are a corporate entity and also registered with RBI or IRDA or SEBI, you have further disclosures. Okay, if you are RBI, the RBI says that every financial statement has to get disclosures on various ratios. What is your NPA? What is your gross NPA, net NPA, and so on. If you are IRDA, then the insurance regulator will mandate that you give the coverage ratios as to are your assets covered, are your risk covered, and other things. If you are SEBI, regulated in SEBI, they will say that you please give us the use of funds. If you have raised funds in the last year, please write separately in the notes to accounts how have you used those particular funds. Now, for all of this, you can have checklists. And we always suggest that first decide what is the framework applicable to you, then follow the respective checklist which is there. So if you are a non-Ind AS company, you will follow division 1, follow that checklist. That checklist will also require everything other than the last thing, because then you may not have to follow the statute regulation which is there. If you are a NBFC, then follow everything and also follow the statute applicable of RBI which is there. If you come to a non-corporate entity, things are little simpler, because then your guidance note for non-corporate entities apply. Instead of Schedule 3, I will follow the guidance note format. There is a LLP guidance note. There is a non-corporate entities guidance note. Accounting standards, whatever is given by the institute, they apply to you and you follow all the disclosures. MSME is common for everyone, so that you cannot avoid. And you may look at some exemptions or relaxations which are available to the entity. And that we will see little later on, as to the institute gives you some relaxations from various disclosures which are there. If you are a corporate entity and you fall as a small company, you may again have some exemptions which you will use when you are following that applicable accounting standard. So this table, no, is something like something absolutely which you cannot forget. And this is something which we tell all accountants and tell all the people in our office who audit companies. That please make sure that your checklists are available as per the right framework which is there. If you follow a wrong framework, then obviously your checklist is wrong and obviously your financial statements are wrongly prepared in that sense. Okay. Now, before I come here again, let me take a pause.
Sir, can we have a queries?
Yes. Well, that's what
Yes, sir. Sir, I'm just sharing on the chat box, sir.
Yeah. So what are the key components of a financial reporting framework? I have discussed some of the key components, no? The format, what is this operating cycle, what is current, non-current, how do you do consolidated? All those are components of a financial reporting framework, no? Besides those 6 main things: balance sheet, P&L, cash flow, notes, and so on.
The next query, sir.
Why is compliance with a financial reporting framework important for companies? Now, you are asking me a question, like I'll give you a comparable question. In India, and I started with the example of learning driving. In India, we follow that left-hand side driving. However, in India, you say that I don't want to follow left-hand driving. Let me follow the American framework of driving, which is on the right-hand side. If you follow the right-hand side driving framework, which is as per United States, what will happen? You'll either have an accident or someone is going to fine you or penalize you. Now, if you see the question, no, put up that question again, Nisha.
Yes, sir. So this question is saying, why is compliance with the financial reporting framework important for companies?
Correct. Now, if you don't follow the framework, obviously your financial statements are not prepared in accordance with the regulation, and therefore the Ministry of Corporate Affairs is going to penalize you. Just as I compared, if you start following the US framework for driving, someone is going to punish you. So if you don't follow the framework for companies, MCA, the regulator, is going to fine you. Because what that means is you are not following Schedule 3, you are not following the accounting standards given by the Companies Act. So obviously you will be penalized, and forget the company, the auditor also may be penalized if he doesn't report that the correct framework has not been followed.
Right, sir. So next query is, what is the significance of materiality in financial reporting?
So what we tell companies is something which is minimum necessary as per Schedule 3, you cannot avoid even if it is not material. Say for instance, you have got something like contingent liabilities. Now, if you have contingent liabilities which are necessary as per the Schedule 3 format, then you will have to give it even if it is not material in that sense. Materiality as a concept does not come anywhere. It is not there in the Companies Act nor there in the uh, accounting standards which is there. However, there is only a background to the accounting standard, the conceptual framework as we call, which says that if you are disclosing some information which in the overall scheme of things is not really material to understand the financial statements, you may ignore it. In case you do that, you are not strictly following Schedule 3, but with a disclosure, you can say that I am not disclosing, say, a company which is a turnover of, say, 10,000 crores and a profit of, say, 1,000 crores. It may say that I am not showing contingent liabilities which are less than, say, 1 lakh rupees. With that disclosure, then it is enough because that is then materiality looking at the overall concept. But the regulation or the law does not say anywhere that follow materiality. It only comes from the conceptual framework of the accounting standards.
Yes, sir. So next question that has been sent is, what is the concept of true and fair view in the financial reporting?
I think we'll come to that when we come to audit reporting, because true and fair is not from a company's perspective, it is more from an auditor's perspective in that sense. And there is a section on audit reporting down the presentation. We'll answer it at that time.
Fine, sir. So next query that we have received is, can a company change its financial reporting framework?
I mean, the answer is obvious. You cannot change, unless you change your company to a LLP. Otherwise, you cannot, again, as I compare and say, you cannot say that, okay, I want to change from left-hand driving to right-hand side driving.
Right, sir. Sir, one question is from my side, sir, while listening to your this session, sir. Sir, you have said there is a provision of separate disclosure for extraordinary items in non-corporate entities,
Yes.
whereas there is no such requirement in the case of the corporate entities. So, sir, why there's a difference, this of disclosure of extraordinary items, sir?
So I don't know, this guidance note came from which committee?
Sir, from our CLCGC committee, sir.
So I mean, whoever group formed that, we'll have to amend that, no? Because if I showed that format, correct? It says profit before exceptional and extraordinary items. Correct?
Right, sir.
Now, when
Right, sir.
you use the word extraordinary, the fact that you are using the word extraordinary means that you are assuming that that is possible.
Yes, sir. Right, sir.
Maybe
So,
you
yes,
need
sir.
to remove it.
Sir, there are a few more queries, but yes, they are of generalized nature. So, sir, can we continue with the queries, sir?
Yeah. Queries or presentation? What do you want?
Yes,
Queries?
sir. Yes, sir. Sir,
Okay.
further, more queries has been asked. One query that has been raised is with respect to how does the adoption of a financial reporting framework
How does?
influence the decision making?
How does? Can you repeat? I could not get it properly.
Yes, sir. How does the adoption of a financial reporting framework influence the decision making process of board members and investors?
I don't know what is in the mind of the querist, but if I don't follow the correct financial framework, you are not getting the information which is required as per law, no? So if the board of directors of a company are given financial statements which are prepared in the framework of a LLP, then obviously they are getting wrong information, no?
Yes, sir. Right. So, there are also some other queries. Some has asked, what are the consequences of not adhering to the financial reporting framework?
Again, obvious answer, you can be penalized by MCA by not following something. And I can give you lots of orders of ROC which have said that this disclosure, which was necessary by Schedule 3, has not been done. Therefore, we are penalizing the company for 10,000 rupees and 25,000 rupees. Several orders of the ROC available that way.
Hmm. So, one more query that we have received. How does the financial reporting framework impact the financial decision making?
It can impact financial decision making. Maybe not internally, but externally. Because externally, if the financial reporting framework is giving you a lot of information, you can analyze the performance of a company from that. And externally, the decision making can be influenced. And again, the example I will give is say of trade receivables. If you have trade receivables which are say 10 crores and the disclosure of trade receivables says that out of 10 crores, 9.5 crores are all more than 3 years, then externally, someone who says they will say that, okay, this is not a company which is recovering its debts very fast. So it can influence decision making of someone else. Internally, they are obviously aware, but it can influence decision making in that sense.
Sir, again, next query, sir. How does a financial reporting framework enhance investor confidence, sir?
if you follow the framework and if the auditor says that the framework is followed, I'm assuming that the auditor has a proper look at it and confirms that everything is followed, then obviously you can say no, that I am getting all the information which I am supposed to get. It's like something, whether you are a safe driver or not a safe driver. If the driver has a certificate that I am following all the rules of the driving, then you enhance the confidence in those drivers, no? Similarly, companies who follow the framework, auditors who don't qualify the reports, obviously the investor knows that everything is, as we call in a simple language, hunky-dory or something.
Mhm. Sir, you have given the reference of Section 43B, which was the recent amendment that has been added. Sir, just want to have an idea about this particular provision.
So 43BH, that's the exact provision in the
Oh,
Income Tax Act, which came from assessment year 24-25. And that said that in case you have got any payment to a MSME vendor and you are not paying that vendor within 45 days, that entire expenditure would be disallowed and allowed in the year when you pay that money.
thank you, sir. Sir, one more thing, sir, that you have said during your session itself that certain exceptions have been given to the small companies with respect to following of accounting standards.
Correct.
So, what are that exceptions, sir?
It down, no? We listed it down, no, in one of the slides.
Okay, sir. Okay, sir. Fine. ठीक है sir, we'll see into it, sir. We will just check with your slides also, sir, later on
Yeah,
once
yeah.
again, sir.
Okay.
Yes, sir. Sir, we
Okay.
can continue with the session, sir. These were the queries, sir.
Okay, I'll just start sharing again. Okay. So let's come to this applicability of accounting standards, because this is something which everyone wants to know as to what applies, what doesn't apply, and so on. I put it very simply here in big blocks so that it's very easy to understand. So for corporate entities, you have accounting standards or Indian accounting standards. So, and for non-corporate entities, they are accounting standards issued by ICAI. For corporate entities, the AS and Ind AS are notified by the government. They are part of the accounting standard rules, as they are called. For non-corporate entities, they are all issued by the institute. So please don't get confused between the fight which is going on between NFRA and the ICAI on what is a standard, what is this, what is not that, because that is only as far as corporates are concerned. For non-corporate, all standards are issued by ICAI. Now, these are the number of standards. If you go to Indian accounting standards, there are 40 Ind AS standards which are there. If you go to accounting standards, there are 27. If you go to accounting standards issued by ICAI, again, there are 27 standards. The second and the third are very similar, but there are changes, and there are changes which you should be aware about. I am not bringing out the changes here, because this is not a session on accounting standards in that sense, but you should be clearly aware the first two are for corporates, the third one is for non-corporate entities. Then, what is the applicability to all corporate entities? Accounting standards are applicable to all entities whose net worth is less than 250 crores in the immediately preceding year. Indian accounting standards are applicable to all listed entities and to all entities whose net worth exceeds 250 crores in the immediately preceding year. Fine. Now, this we are talking only about accounting standards given by the notified notification of the Ministry of Corporate Affairs. When it comes to non-corporate entities, you have accounting standards issued by ICAI. Again, the breakup is for MSMEs and for large entities. For MSMEs, selective accounting standards applicable with some relaxations. For large entities, all accounting standards are applicable. And if you recollect, there are 27 accounting standards which are there for non-corporate entities. And we are getting into what is this MSME and what is this large entity. Now, ICAI has just revised its scheme for applicability of accounting standards to non-company entities. The effective date is from 1st April 2024. The definition of MSME has been revised. Now, this is something which came only in maybe the last 2 months. MSMEs have to disclose that they have complied with the accounting standards applicable to MSME. Entity which becomes a MSME will be required to follow all accounting standards, exceptions and all will not be allowed. So if you are first a large entity and then become a MSME, you don't get any exemptions as such. The last part of that slide is a link to an article in a newspaper which says that very soon the Ministry of Company Affairs is going to put LLPs and companies on par in accounting, which means that the notified accounting standards for companies can soon get applicable even to LLPs per se. Okay. When you get this presentation, open the link and see, and this is as likely to come in the December session of the parliament, which is there. And that would mean that the institute standards will then really apply only to partnerships and proprietorships. To LLPs, again, you will have accounting standards which are given by the government as such. Now, what is a MSME as per the institute's definition? And the institute has fortunately changed the definition to bring it in line with the definition which is there in the Companies Act. So if you are a non-corporate entity, your turnover is less than 250 crores or borrowings are less than 50 crores, then you are a MSME, but you cannot be a subsidiary or anything of a holding company. And anything which is not a MSME is a large entity per se. So they have linked this definition to what is there as a definition of the small company in the Companies Act itself. But this definition applies to LLPs, applies to partnership firms. Now, you may have a thought in your mind that how can a partnership firm have such a big size? But let me tell you, in our day-to-day working, we have seen partnership firms and even proprietorship firms having a turnover of 1,000 crores. You can have a LLP having a turnover of 1,000 crores, especially if it is in the financial or the fintech sector, as it is called. Now, these are standards which are applicable to large entities, and though the numbering goes from 1 to 29, there are 27 standards because you will not find here AS6 and AS9 in that sense because they are merged with the respective standards. And these are the relaxations which are applicable to MSMEs. And this is very similar to the relaxations applicable to corporate entities also. Now, do not confuse this MSME with the MSME, which is that 45-day payment period and vendors and so on. That is a separate act of MSME where the disclosures happen. And this is only as far as accounting standard exemptions are concerned. So, okay, you have got these 5 standards not applicable and relaxations given in disclosure of various standards. Now, you can compare this exemption for non-corporate entities with the exemption which is applicable to corporate entities, and the institute has now aligned it more or less to be same in both cases. Earlier it was different, but now with this a new announcement which came before 2 months, they have more or less aligned everything to what is there for a corporate also. Okay. So we go on to audit reporting. There was a question on audit reporting, which I am sure should get answered in this. Now for companies, how do companies issue audit reports? Now, the Companies Act lays down reporting by statutory auditors, and the section is section 143 of the Companies Act, and there are subsections 1 to 15 which lay down the reporting requirements. Again, we are not having a session on audit reports. Otherwise, each of these clauses can take 5-10 minutes to discuss, but this is broadly summarized. You have section 143(1), which reports where you have to report on 6 matters only if the answer is in the negative. In 143(2), there are few clauses. Some of them talk about whether the financial statements comply with the accounting standards and the standards on auditing. Now, this is where NFRA is come up with that power that it says, NFRA clearly says that complying the standards of auditing is not something which is only with the institute now, it's a regulatory mandate because the Companies Act under 143(2) says that you have to comply with standards of auditing. So as an auditor, if you have not followed this, NFRA believes that they are well within their right to punish an auditor if the essays are not followed, which has happened in a lot of cases, even with the bigger firms, smaller firms, and so on. 143(3) is the main clause, main subclause where there are several points which you have to disclose in the audit report, whether the accounts are in line with the financial, with the accounting standards, whether the books are in line with the financial statements, whether it gives a true and fair view and so on. There is also a clause there which includes this reporting on internal controls over financial reporting, which is there. And the query which was asked is, how does the financial reporting framework ensure true and fair? It ensures true and fair because if it is not true and fair, the auditor is here supposed to report that the financial statements do not show a true and fair view. So from a company's perspective, if you follow the financial reporting framework, which we saw is those 5, 6 things which are there to disclose, then it is showing everything which is true and fair. It is then assumed it is true and fair unless the auditor says that things are not true and fair. So it goes in a little different way as to companies don't have to say things are true and fair. But if it is not true and fair, the auditor reports that it is not true and fair. Then you have got 143.4 to 143.10. These are several other clauses on branch reporting, CAG reporting, and so on. 143.11 talks about reporting under CARO, in which itself there are some 25 clauses which you report on. 143.12, which is in the news nowadays, is on reporting on frauds. You have got 3 more subsections there, 13, 14, 15, which talks about that the same rules on reporting also apply to company secretaries and what is the process for reporting on these frauds which are there. Now, the Companies Act only tells you what is to be reported. Correct? So this tells you what is to be reported, section 143, which is there. How do you report comes from the standards of auditing. Now, these standards of auditing will tell you how to do a report. What is to be reported comes from section 143. And you have got the standards on auditing which have been issued by ICAI, but they need to be notified by NFRA and MCA to really become applicable to companies. Because unless NFRA recommends it to MCA and MCA notifies even a auditing standard, it does not apply to the auditors in that sense. Because the role of the institute is only to formulate the standard, making it mandatory to be applied is by the NFRA, followed by the notification by MCA per se. And this is all what we read in the press about NFRA overtaking the powers of ICAI and ICAI saying that we have the power and so on. Finally, I'm sure it will get resolved, but as the law stands, ICAI will formulate the standards, but finally they do get notified by the Ministry of Corporate Affairs. And these are the standards on auditing as to how to report, and this is applicable to all entities. Now, if you look my earlier slide, section 143 applies only to companies. But when I come to this standards on auditing, it applies to all entities. Okay. So 700, 701, 701 is only for listed entities. Even in corporate entities, it's only for listed entities that is brought out in 701 itself. Otherwise, everything else applies to all entities, whether corporate or non-corporate. And that is why if you are giving a report under a tax audit, if you are giving a report for a LLP, you will still have to follow a format of SA 700 because the standards on auditing applies to all entities per se. Now, again, you may have a question that if I am not a company, but I am an LLP, NFRA does not apply to me. Ministry of Corporate Affairs mandate does not apply to me. Then why should I report under SA 700? I will give some other format. Now that comes in because again now of the mandate of the institute. The institute has said that if you are a non-corporate entity, your reports have to be in this format which is there. And that is why in a tax audit report, though there is a form 3CA and a form 3CB which is given, which we will shortly see, the draft of the report has been modified in the guidance note on tax audit to include the paragraphs and the clauses which are given in SA 700 per se. So SA 700 is something like a Bible for all auditors that you need to follow this, whatever be the audit report which you are issuing in any case, whether it's a corporate or a non-corporate entity as such. So that takes you to this tax audit. You have got this 3CA, 3CD, which is for corporate entities, 3CB, 3CD for non-corporate entities. And that same thing is listed here. It is put in different colors to make it little easier for you to go through this. But if you have a tax audit, then these are the forms which you follow. And 3CA is for professional businesses requiring mandatory audit under law other than income tax law, a single form containing audit details obtained from multiple documents, which is there, can be submitted by any applicable tax assessee irrespective of income or turnover. And 3CB is, even some companies obtain a tax audit report in 3CB because if you are having a year end which is December, which is as per say your holding company or subsidiary company, but for income tax, you also necessarily prepare for April to March. In such cases, your reporting will be under 3CB because you don't follow that first requirement of for a December ending, you don't require audit under any other law, and therefore 3CA doesn't apply, but 3CB applies in that case. Okay. And the last thing which I'm going to take you through is this few common errors in financial reporting. And obviously, typically, this is based on the financial reporting frameworks which you follow. Now, these are some common errors noticed in the FRF for corporates. And this is just a listing of what is our experience in the last maybe 10-15 years on some common errors noticed in the financial statements of corporates. Non-disclosure of aging analysis, secured, unsecured, dues from directors, final amounts not tallying with the disclosure amounts. So in your notes to accounts, there are figures which don't tally with your main balance sheet figures which are there, and it is not necessarily because of rounding off. Disclosing share application money as part of shareholders' funds, they are typically not shareholders' funds till you allot the shares. Cash flow statements not tallying. Now, this is a serious error because cash flow is the statement which no one really pays attention to in practice, whether it is the company or the auditor. The company tells the auditor, you can finish this is your responsibility. The auditor, the partner tells his junior staff, just go and tally this because you will do it better than me. And at the end of it, no one looks at cash flow, but that's a serious mistake. Cash flow statements also, we have seen orders of the registrar of companies saying that the cash flow is not properly prepared, wrong classification there, and therefore they have penalized the company, and they can as well penalize an auditor also in that case. Incorrect classification of short-term and long-term borrowings, details of title deeds of immovable properties not held in the name of the company, shareholding pattern not disclosed, formulas for the ratios not disclosed, reconciliation of cash and cash equivalent not done in cash flow statement, a definition of RPT or related party not done, leading to violation of accounting standard. Now, these are just a sample of some errors, not that these are the only errors. You can have lots of other errors which come in, and they typically come in because as per the financial reporting framework, you have checklists which are available everywhere. It is mainly because you are not following the checklist. As a company, as an auditor, give the checklist to the accountant, let him follow the checklist. As an auditor, you also follow the checklist and see whether everything is done or not done. And there are, I believe, some softwares or some, I would say, macros available where it allows using artificial intelligence to ensure that you have gone through all the disclosures. You have not missed out any disclosure per se. Now use that, especially if you are doing multiple company audits or if you have a lot of companies in your group. Use some software which has some artificial intelligence. Even Tally in that sense will have query features, which is nothing but using some logic in identifying whether things are right or wrong. Otherwise, as I said, not doing something under a FRF can lead to penalties, can lead to a lot of other issues which are there. When it comes to non-corporate entities, we have still seen financial statements prepared in horizontal format rather than vertical format. Now, horizontal format is just not allowed. Please ensure that if the promoters or the partners say that I am more used to a horizontal format, give him a separate P&L balance sheet for his consumption. But for regulatory purpose, please prepare it under vertical format. Tax provisions are missing. They say that tax is not relevant for a non-corporate entity. It's missing. If it is missing, it needs a qualification from the auditor. Employee benefit provisions are missed. So you don't follow the approval system of accounting. You miss out gratuity provision and so on. MSME disclosures are missed because MSME, there is no exemption for non-corporate entities as we saw. Even LLP needs to give that. there is no clarity as to which accounting standards you have followed. You will not write, you will have to write there that we have the LLP or partnership has followed accounting standards which are notified by the ICAI. In a company, you do write, no, accounting standards as notified under section 133 are followed. Similarly, in a non-corporate, you have to write what accounting standards you are following. If you write as per ICAI, at least someone knows you are following some standards based in India. Otherwise, no one knows whether you are following Indian standards or say Pakistan standards which are there. Then applicability exceptions, relaxations to the entity, preparation of accounting policies that is not sometimes given, incorrect terminology used, cross-referencing not done, rounding off not done. Non-corporate entities also, as I said, though the guidance note uses the word may, I think it is almost becoming a mandatory thing that you need to do a rounding off in such cases also. So I think with this, I would come to an end of the presentation, but I'm sure there would be a lot of queries which are there because though this was a very basic topic, um, and I'm happy that the CLCC got this topic for a webinar because um, there are a lot of errors and lot of things which people are not aware about. And as it is said, no, when you have some basic things, they keep on getting forgotten because you are looking at more important things and the basic things get forgotten. And this whole session was really getting back to the basics of what is a financial reporting framework which is there. So I'm going to stop sharing this. As I said, I will share this entire presentation to the committee, which they can send it to you or put up on the website, and we can have some more interactions which are there.
Yes, sir. Sir, one question that you have raised with respect to that the accounting standards
Yeah,
are to made applicable to LLPs also. So, sir, you have given a link over there. Ki, yes, I can go into these details with respect to this particular part.
right.
So, sir, one person has said that thank you for sharing this information. So that way it was a good, wonderful knowledge sharing. So he appreciated that way.
Yeah, no, because this is what is coming in the future, no? And you see the economic times of last few days, you will get that easily. But for convenience, I put up the link itself.
Yes, sir. And sir, the one question that has came with respect to common errors that have been noticed in the financial reporting framework. So, sir, you have pointed out certain what are the common errors there in the financial reporting. So, sir, one question that has came across is that how the is there any way to prevent this common error to be caused, sir? How that could be done up, sir?
I told you, no, you use the checklists. Even the institute has given lot of checklists for Schedule 3 for accounting standard disclosures and everything. So use the checklist.
Okay, okay, fine, sir.
It's the experience which counts, no?
Yes, sir. Absolutely, sir. Right. Sir, one more question is there ki, what is the impact on compliance with the accounting standards?
What is the impact on compliance?
Compliance with accounting standards.
So I think if you comply with the accounting standards properly, your accounts are obviously becoming more and more transparent, no? And the auditors would be happy, the regulators are happy, the investors are happy, the analysts are happy. If you give, say, revenue recognition, a lot of details on revenue recognition, which is required as per the standard, the investor will be able to understand your company's revenue model better, no?
Right, sir. Sir, basically, what are the natures of the errors? Because you said ki there should be no error in the financial reporting framework, sir. So, what are the nature of these errors we are just discussing over here, sir?
I think the errors are more in the nature of disclosures. That you miss out disclosing things, you miss out classification, you miss out in a cash flow statement what is to be done. Your profit may remain the same, and we have seen in practice that the company says, my profit is the same, so I am not bothered about whether I disclose something more or less. Even the auditors teams, take that same view that if it is disclosure, okay, we are not really worried. But I think financial reporting framework is ultimately about disclosures which are there. It's not necessarily about the figures which are there. So if you don't disclose your accounting policies, whether it is accrual or cash basis, and of course cash is not allowed as a accounting policy, then though your profit figures in that sense are correct, but then you are not coming up with a proper policy disclosure, no, to be able to understand for outsiders.
Right, sir. Sir, that's it, sir. Queries already I have raised all the queries that has come across over during this session before put up has been before you, sir, and you have already discussed it very nicely, and it has been sorted out to the satisfaction of our viewers, sir.
Okay.
So this was a really a wonderful session, sir, because the way, sir, that you have given the presentation in simplified manner, different distinguishing between the corporates and the non-corporate entities. That was really great, sir. It was easy to understand and to relate
Yeah.
how the thing should go on. This was wonderful, sir.
Mm.
And sir, with respect to sir, this thing, sir, Seema was there to give you a vote of thanks, sir. But since due to exigencies, sir, she's not able to join.
That's
So,
okay.
sir, on behalf of Corporate Laws and Corporate Governance Committee, sir, I would heartily thanks you, sir, for sharing your wonderful knowledge and insight on today's topic related to the financial reporting frameworks for companies and the other entities. And the way, sir, you explained how the governance, the transparency, and the fairness is to be maintained
Yeah.
while laying down this reporting framework. It was wonderful. And thank you, sir. Thank you on behalf of the chairman, sir, on behalf of the CLCG, and behalf of every technical team, sir, and behalf of our viewers also, sir. Thank
Thank
you, sir. Thanks a lot, sir.